Good morning, traders. My name is Christopher Vecchio, currency strategist with Daily Effects. Today is Thursday, February 11th, 2016. These are your FX headlines as we turn the page to North America, and thank goodness that we're turning the page because it's been a pretty quiet calendar. Up on the Daily Effects economic calendar, only Swiss inflation for January. Ugh, boring. That's really a snoozer. Swiss data these days seemingly has very little sway over what's going on with the Swiss franc. But overall, the situation there is fairly interesting because you're seeing still steep deflation. Speaks to the fact that the SMB really wants a weaker currency. And right now, their efforts to keep it weak are becoming increasingly difficult. So they may move to do enhancements to their program. Their easing programs maybe more like what the BOJ is doing, even though the S&B has tiered out its current accounts and capital accounts, that these financial institutions hold with it. Ultimately, the way that the BOJ is doing it by deflecting or disincentivizing excess reserve accumulation may be the path that the S&B goes down with even steeper negative rates that they were employing now, right? Because the theoretical floor to theirs is negative 0.75%. And their currency is still, having a difficult time of things. The yen is too, and right now it probably means that these central banks will have to go even more negative. So just keep an eye on that. Swiss franc is not something we're really paying attention to a lot these days, but in light of the fact of some of the recent moves, seeing here that we are breaking this significant longer-term uptrend. S&B is coming into play with a little bit more difficulty here. Euro's rallying up. They might be in the market to talk about some things and respond sometime shortly. But this does look like it is a viable top up here. Truncation, lower high at the top. Indicators now in bearish territory. So keep an eye on dollar Swiss. But when we go through the U.S. economic calendar for today, you see that Yellen is appearing before the Senate Banking Committee. Thankfully, it'll be a little bit more a constructive session, although it is in election year, which means that this is mostly political circus. I mean, yesterday's testimony before the House Financial Services Committee was nothing short than a joke. I really don't have any kind words to say about it. There was both a clear misconception, a lack of fundamental understanding about what the Fed does. Clearly, Congress thinks that the Fed is acting unwieldy and outside of the realms. Clearly, there are some attendees that think the Fed is, taking away stimulus from an economy that could still use it. At the end of the day, let's just be clear. Congress outlines and passed the law that dictates and mandates what the Fed can and can't do. The Congress passed the law that mandates that the Fed has to pay interest on excess reserves to banks. All right? It's Congress that has to pull the fiscal levers to stimulate the economy. The Fed and its monetary policy is simply, the grease that slicks the gears. The fiscal policy is what puts the gears in motion. And the monetary policy, cheap credit keeps it going. If the machine overheats because credit's too cheap, there's too much, so to speak, lubrication on the gears, then the machine breaks down. That's why from time to time the central banks tighten policy or, they stop trying to lubricate the machine. All right, there's no clearer way of putting it. The Fed cannot do much more. There's a marginal cost of production, so to speak, with what more monetary policy can do. The first QE program was very impactful because it was unexpected, because you're adding a lot of liquidity to market, because the Fed's balance sheet was a lot lower. But to have the same type of impact now, 5, 6, 7 years later, the package would probably have to be bigger in nature because the portion of the overall market that it would affect would be smaller. All right. So going forward, and we're thinking about everything that the Fed's doing, let's keep in mind that when you have these policy officials, particularly Congress members, coming out and lampooning the Fed for what it's doing, it's because they need to look good in front of their constituents. It has nothing to do with the Fed's going to actually go ahead and do with monetary policy. Quite frankly, there are other issues at play. They can't cater to the lowest common denominator of people who have no understanding of how the financial system works or what the Fed actually does or who gives the Fed power. So, looking forward to today's Senate Banking Committee. This should be a more adult conversation, although, again, don't discount anything. It is an election year, and this U.S. election cycle has been, pretty vicious, anything but presidential. think when we look forward to this, we could still look for remarks that the Fed is optimistic, but is monitoring the short-term developments in financial markets and global economies. And of course, if those developments continue to turn sour, then they will take the steps necessary to shore up the U.S. economy. That's writing's been on the wall. They're data dependent. Ultimately, I think that they're going to backtrack from a March hike. They'll be looking to raise at least once in the first half of this year. They'll be trying to just try to retain some credibility, but ultimately it doesn't seem like right now the market's looking in that direction whatsoever. So U.S. dollar index here is starting to slip. We said yesterday we're looking for a move down below 12,035. We got that close there yesterday. So let's see if we can have some further continuation now that both indicators are in bearish territory. The big mover, of course, today is the Japanese yen, strengthening gratuitously across the board. But quite frankly, this is kind of within our realm of expectation. On Tuesday, we issued a call for dollar yen to move down to 106. At the time, price was trading right around 115.60. So the fact that we're down here 500 pips later, it is a steep development. It's a fast development, but it fits with the prognosis, which was that this head and shoulders pattern calling for a move down to 106 after a break of the uptrend from the 2012, 14, and 15 swing lows. At this point in time, we do think that the BOJ is losing control of their situation over there. We've been pounding the table on this for several weeks now. Last week, it became eminently clear when the Ministry of Finance canceled their 10-year bond auction that the BOJ's actions by pushing yields negative out all the way to 10 years at one point this week, as it turned out, would reduce demand. And of course, the Ministry of Finance canceling that. The BOJ owns 32.6% of outstanding JGBs right now. They're on pace to own over 50% by July 2018. It is disrupting the bond market. It couldn't be clearer. And so at this point in time, investors, seeing that the BOJ's tiered out recent efforts to deter investors from accumulating excess reserves with the BOJ, is nothing more than an effort to competitively devalue the currency. And so the market's seeing right through this. They're not buying into the BOJ's game. And as it were right now, the yen is having another exceptionally strong day, rallying across the board. Pound yen remains one of these super clean technical setups, right? We talked about this last week. Sold off into a former low all the way from February 2014, rallied up into the former highs from April 2015, sold off. Aussie yen likewise, very, very clean. Triangle sells off. Bearish rising wedge into former triangle support, sells off. Rebound into a former swing level. Evening star candle cluster into that former now resistance, sells off. Indicators turning lower. The yen is in a very clear, technically strong momentum market right now. This is not something you should be looking to call the bottom on. And you know what? You look at retail crowd positioning in dollar yen. Retail crowd still net long, trying to fade the move. They've been wrong the entirety of the move thus far. Still don't want to trust them now. Until they flip positioning and buy into it, it's hard to look for a low. And certainly this type of price action, you're catching a falling knife here, you know, almost literally and figuratively. When we look at euro dollar, still moving up above 113 here. Again, still think that the ECB is going to start to have some issues with what the euro is doing. So, you know, in view through that context, probably take on a little bit less exposure to the euro overall. Selectively, though, euro pound is still interesting, so this would be one of the two places I might look at it. Euro pound here, we've been looking for this inverse head and shoulders pattern since mid-January, since about January 10th or 12th, to move up to about 81 here, 80.60 to 81 target range. Very clean pattern here too. Inverse head and shoulders, breakout, run into former support, now turn resistance, consolidate for a few days, run into the uptrend, break out higher. Looks like we're now on our way towards those 80, 60, 81 figures. So euro pound still has a chance to move up. I think the political risk for the pound this year is enormous. It's growing. I think that, unfortunately, the vote that we're seeing for Brexit's going to be a fear one, driven by emotion. Ultimately, I don't think that caters to a rational decision, and that the economic fallout for a UK exit from the EU would be very steep very quickly. So, you know, political risk for the pound running higher. I think that the fact that the market is kind of seeing that the ECB is having difficulty keeping the financial sector in healthy condition while fiscal policymakers flag on a number of issues. And you know what, I really think that the fact that we're seeing fiscal policymakers have trouble finding agreement on the immigration issue is spilling over to the market, insofar as if they can't agree on something like that, and they say close off Greece from the Schengen zone for, say, a freeze-out period of 2 years, getting Greece to play ball on other issues where they're no longer considered a full-fledged EU member, maybe not in Germany's eyes, but certainly in their own eyes, it's going to create consternation. And finding agreement between policy officials will be even harder on, say, fiscal issues, like a bank recapitalization. So at this point in time, these effects of what's going on in Europe, immigration is an issue for the UK voting populace as it refers to the referendum. It could be an issue right now as it spills over with the Schengen zone. This political risk is very high. It's an existential threat to the idea of European solidarity, questioning everything that's been put forth since the European coal and steel community all those years ago in the post-war era. So there are some big things in play here. Let's not discount them. The Brexit risk is high. I don't think you can trust the pound at really any point this year. Euro pound we know is moving topside, pound yen moving lower, pound dollar moving lower. Our focus today, though, is US dollar index. Let's see if we can get another close below 12,035. We're putting in a little hammer down below here. The yen is obviously strong, but the euro's coming off. The pound is now coming off. Aussie's a little bit lower as well. Keeping these things in mind. Greenback needs these other currencies to play ball, all of which are fraught with their own issues, right? So that's it for me today. I'll be back later on with another video, a little bit longer today, but had a lot to say about that very frustrating Financial Services Committee hearing yesterday. An absolute joke. I mean, there's really no kind way to put it. And, if you have your congressman, call him up and tell him that he needs to read a book, an Econ 101 book. There are 18 and 19-year-olds running around at colleges across America that have a better understanding of what the Fed does than these officials. So, diatribe over, trying to be nicer for Lent, so let's go through with that. As always, if you have any comments or questions, feel free to reach out to me through the DailyFX Real-Time Newsfeed at CVecchioFX. StockTwits and Twitter is also applicable there. You can email me, cvecchio@dailyfx.com. If I don't speak to you before then, good luck trading the rest of this week. Tomorrow morning, if you're interested, I'll be hosting a webinar for Eurozone GDP. That's going to be at 4:45 Eastern, 9:45 GMT. Would love to have you join me there. Beyond that, DailyFX On Demand runs every day during the week, 6 to 7 Eastern, 11 to 12 GMT. Again, appreciate your time and attention. Good luck trading the next few days.